All right, and we're back for episode 11 of the Cash Flow Corner. Today, we're excited to have a very special guest on today, Stuart Heath of Harvard Grace Capital, based out of Spring Hill, Tennessee. Excited to have you on. How are you doing today?
Doing great, doing great. Really appreciate you having me on.
Yeah, I know we've tried to get a few more guests on who are really in the day-to-day of commercial real estate. I know you're the CEO of your company and you've been in investing, it seems like, for quite a while. I know you've been an entrepreneur for over 25, 30 years. So really excited to have you on, get your expertise and pick your brain, and hopefully our listeners gain some knowledge out of our episode today. So excited to get started.
Whatever's in my head is free for the taking. So happy to share.
Perfect. Yeah, and I'll jump in here just to kickstart the conversation here, Stuart. And if you could kind of just give a little more background on yourself for some of our listeners that might not know who you are. Just kind of walk us through, really, I guess, how your journey started in the world of real estate. Where did you kind of get your start? And yeah, if you just want to share your story, that'd be great.
Yeah. Well, it is interesting today with sort of the Fed news, which I'm sure we'll talk about later. But I came out of college in 1985, and the next year they passed the 1986 Tax Reform Act, which pretty well destroyed sectors of the commercial real estate industry for a season. Especially apartment buildings and things like that that were financed as investment partnerships and with retroactive takebacks of tax benefits and stuff like that. And so I kind of came out of the world, of being a baby business person, and thinking and being told and believing that real estate is bad. And I remember sitting in bank meetings and chamber of commerce meetings, and where bankers are talking about how they don't do real estate anymore, and it was all rather passe. And I guess they would prefer collateral that has wheels and can move across borders and stuff like that. But as a CPA, and I was with a big firm, and then I went out on my own, and I started to pick up several clients. It seems like one way or the other, almost everybody's in the real estate business. And so I had, savvy real estate agents, I had developers, I had builders, and everybody was making money in real estate. And so I started taking notice and just realizing, gee whiz, I'm missing something here. This bad asset class of real estate there's a lot of people in it and they're making a lot of money, and there's a lot of, and I'm their CPA, and I'm like, and they're not paying any taxes. So anyway, I just began to start to take a look at it. I began to dabble in real estate and bought my first duplex at one point, and then after that, I was kind of hooked. Within a year of that, I'd bought 14 duplexes, 14 more, and was starting a property management firm inside my CPA practice, and from there I built houses and I did some development, and it's just it was really in my blood, and I just didn't know it. So just really kind of fell in love with the power of real estate, the power of recurring cash flow, the power of tax benefits used properly, and really the power of leverage. I didn't always use leverage properly. I didn't come out of the great financial crisis very well, but I realized it wasn't the real estate's fault. It's not the wood's fault if the carpenter uses the tool wrong. So came back through that, got reset up, and realized what I liked and didn't like. I don't like residential properties that I have to manage. I think residential is the queen of all real estate, but I don't like to manage them because people are crazy. And so I've really pivoted to other commercial asset classes We were doing office when people were saying we were crazy, but I'm like, but it's full, and it's still full. We still have those assets. We've got some storage. Love medical office. We closed one this week. That's a medical office building,
Congrats.
and we got some retail. Retail was also declared dead at one point, and then nobody built any, and now there's no space, and it's all full, and the rental rates are going sky high. So we love retail as well. So that's
Yeah,
kind of
that's
my
great.
history.
And I know, like you mentioned, everyone really that we've talked to, any investor, I feel like have that hook where I know we've said it before. If you haven't been investing in commercial real estate, if you've never invested before, it's always that first or second deal where you see how it progresses and what your returns are, especially I know probably for you from a CPA side of being able to see all of the financial benefits. It's that hook or that light bulb moment where it's like, why haven't I been doing this? And I want to do 10 other deals just like this and I don't want to stop. So really trying to get investors more aware of the potential benefits of investing in commercial real estate has really helped us because even from our standpoint of being an LP in our first few deals and just realizing the long-term benefits that we're going to be seeing is really what kickstarted our careers of wanting to do more deals, trying to figure out what ways we could get more people involved because I know it's not something that's commonly known. I know a lot of people just either invest in index funds, bonds, stocks, and really don't think about their investments too much and how they impact the long-term wealth building career that you could have. So I think that's always a great point to note as well. And I guess going from there, like you mentioned, we did have some rate cuts that were announced today of 50 basis points, and I believe that marks as well as another 50 basis point coming here in the near future. So that's exciting. I guess if you want to talk about really what you've seen through the last 6, 8 months or even longer, that interest rate rise. And now that we see rates cutting today and they're going to be hopefully continue cutting in the future, what does your outlook look like from your company's standpoint and I guess a personal investing standpoint as well?
Um, yeah, I think our outlook is that nothing's going to happen fast.
Mm-hmm.
So before the deal we closed this week, the last deal we closed was December last year, uh, and just as a premise, everything we do is a stabilized deal. We're not doing fixes and flips, or we don't have any development risk, and so it's all cash flow and stuff. And so we closed that deal at a 8.25% rate. We just closed this one. We got it at a 7.5. We had offers as low as 6.9 and 7 and stuff like that. The other terms weren't as attractive as the 7.5 that we did. They load them up with points, and you got to realize, it'll take me 4 years, to recoup that rate differential, with all those points and stuff like that. But and I mentioned that to basically say real rates have been coming down since the spring. We've seen a lot of banks, and I think to somewhat they've made a defensive move. They don't want to screw you to the wall and for you just to refinance them next spring. And so they're trying to do a loan that'll stay on the books a while. And so it's kind of a balancing act for most of the lenders. So borrowing costs are going to get lower. At the same time, sellers are not stupid. It took them all of 2022 and beyond to realize that, rates went up 5 points. Before they got real on purchase prices. So they're not going to be as flexible on that. I think the biggest win will come about 24 months from now, after they have probably completed the easing cycle that we're in now. and it might be one of those Katie bar the door, grab and hold on and buy as much as you can. So, or as our buddy Hunter says, back up the truck and load it up. So, because you bring points down two more, two more, 200 more points. Sellers are happy. We're happy. You're going to get one of those sweet spots where you're just going to get a high level of transaction volume. So that's my 2 cents.
Yeah, no, that makes a lot of sense. And when you're referring to the seller and the buyer, there's been that gap over the last, 6 to 12 months. So hopefully with those interest rate cuts, we start to see that gap kind of shrink. And, it goes back to that idea of, like you said, seller being happy, the buyers being happy. That would be obviously a great situation for everyone involved. But now, Stuart, I want to kind of change the conversation here a little bit. I know we were kind of looking towards the outlook of the future and what to expect. And for you particularly, I know you have a big footprint within the office space in particular. I want to move there now and just kind of, there's a lot of people saying office spaces are dead. There's a lot of preconceived notions about what's going on inside the world of office space. So if you could kind of just give us a future outlook. Where's the growth? Where's the opportunity within the next 5 years as it relates to the office space?
Yeah. It's a question on everybody's mind. I'll start off by saying that I think, central business district and class A offices, I think they've got some pain to go through. These are the places where employers used to just have to gather their employees together. And that was primarily the purpose. Employees don't want to go there anymore. And, with technology, you don't have to be together as much. Although Amazon's news is interesting this week. They've ordered everybody back 5 days a week beginning first of the year. Still, they will be a trendsetter, no doubt, but it's not gonna solve everything. Where our office assets are at, and just want to say there are many subclasses of office. I've already mentioned medical office. Medical office is a massive subcategory of office, and it's never had any hiccups. Your doctor's not going remote; he ain't coming to see you, and they got to have somewhere to put those $250,000 MRI machines and stuff like that. And they do these beautiful 10-year leases, and they almost don't care how much they pay for them. So it's a wonderful asset class, and it's very, very competitive. So you take that chunk and you set that aside. Where else? The other asset class that we like, I call it suburban office. I think it might be technically referred to as service retail, but the ones we have, they are the offices for tenants. And the difference is this is the office where they see their customers. So you're talking about insurance agents and mortgage companies and so forth, and dentists, and don't forget the dentists. We all love the dentists. And so this is where they see their customers. That's the difference between that and Class A. In downtown and in Class A, they're not necessarily seeing their customers there. And so these guys who have these facilities to see their customers in, they're not going anywhere. They didn't go anywhere during COVID, and we were worried. I remember we had two vacancies in one property at the beginning of 2020, and I said, well, tighten the belt, boys. It's going to be there for a while. And sure enough, within 3 months, we hadn't already leased both spaces. Of course, that's southern Middle Tennessee, where we all pretended there was no pandemic for a while, for a long time. So, yeah, it's the South. So, but anyway, so I really parse the office market kind of like that, customer facing versus non-customer facing. And, the medical office would fall clearly under customer facing as well. And I think that's the difference. The other guys, the nice, marble bathroom guys and in downtown place, they got some pain to go through.
all downtown areas are, and it's still up in the air. But exactly like you were saying, of those medical offices or the service space of, it's just not really going anywhere. You're going to need your dentists, your doctors. You're going to need those spaces. And I feel like that's another thing where some people that are just getting into commercial real estate investing may only think, oh, it's these large office buildings or these large multifamily buildings, and really don't know more about the retail side. Or even, I know a lot of people are doing storage and trailer parks, and there's just so many options, and it's so broad in terms of the commercial real estate world, where I know a lot of people just see big buildings and they think that's what it is. So I know you're kind of in a few different niches in terms of where your properties asset classes are. And I would say, what strategies do you really give to your investors whenever they're looking to really diversify their portfolio? Maybe they've only been looking at multifamily, or I know industrial is hot right now. So whenever you're talking to investors between different asset classes, what do you really touch on, and what are your main differences that you look for?
Well, we have taken a different strategy than a lot of other asset managers, and it's just different. I'm not saying we're right and they're wrong. A lot of people have focused specifically on multifamily, and rightfully so. I think it's it's that's the queen of commercial real estate. Um, we have focused on a geography and have been asset class opportunistic within our geography, and that's basically southern Middle Tennessee and northern Alabama. We did just stretch that this week and took in Birmingham, um, but it was an 8.75 cap triple net medical office building, and I'm like, yeah, we're going to do that. But still, it's pretty easy to get to. And part of our reason for our strategy is that we do all of our own property management, so we got to be somewhat close. And the rest of it is, I mean, we know this area. Pretty much lived here my entire life, and so that's the right strategy for us, and our investors can appreciate that. Again, I'm not saying anybody else is wrong. There's something to be said about being an expert in a particular asset class. And I think multifamily has a lot of moving parts, perhaps more than other asset classes. So we've got storage, we've got the medical, as we've talked about, the retail and the office. Not a lot of moving parts in storage, other than the roll up doors, So as far as to answer your question, as far as strategy, our entire focus is essentially stabilized recurring cash flow. And will that cash flow increase over time? Are those increases already baked in, on acquisition day, like from long-term leases or whatever? Or in the case of storage, where you don't have long-term leases, do you think that is there more room in the market to go ahead and raise rents? And so in our storage acquisition, we've almost doubled rents there in almost 2 years on that particular property, just because the seller, he's a good friend of mine, but he was just way too cheap on rents, and so we were able to get in there and raise rents.
I love it. Yeah. And, I see that we're already kind of hitting the 20 mark. So I just want to hop in. I know we have a few more questions before we let you go here. And really, the question I want to ask you now, just given the fact of Aaron and I were part of this younger generation, I feel like we have a really good following and base of younger people that are just now really starting to get into the world of real estate. So this is a question for maybe some of those newer people that are looking to, get into the world of real estate. For you, Stuart, if you could go back, I know you have a lot of experience in the industry. If there would be one piece of advice that you could give someone that's looking to get into the industry now and start investing, what would that one piece of advice be? And I guess take it from there.
Um, without being flippant, um, buy something. I mean, real estate is the kind of thing that
Start.
you can do passively. So you can invest with somebody else and let them take care of all the details. You can also do it yourself. And almost everybody understands the process who's bought a home. It's not the same thing, but you understand the process. I would just say just begin because it's not that hard. It's very leverageable. You don't need a whole lot of money, and you don't really need a whole lot of specialized training to get into it either. Uh, you own this asset, somebody else wants to use it, they're going to pay you rent to use it. And you have a lease that's going to describe what you're responsible for and what they're responsible for. And at the end of the day, it's really quite that simple. The other thing I would say is seek out where you're going to get your information. If you are an investor, but maybe not yet a real estate investor, and you listen to Bloomberg and CNBC, you're never going to invest in real estate because as we've talked about, it's been declared dead. Commercial real estate has been dead all year. Office was declared dead in 2020. Retail was declared. Real estate is the single largest asset class in the entire world. It's I don't know. I know somebody wrote this, but I think it's 5 times the capital markets.
Yeah.
The publicly traded capital markets. And it makes sense. We are physical beings, and we exist in a series of different pieces of real estate, from home to office to whatever. And we go to different pieces of real estate to get our entertainment or to get our food or everything we do in life is going from one piece of real estate to another. But don't bother because it's all dead, right? So just you're going to have to seek out reliable information about investing in real estate, and there's plenty of it out there. It's just not on cable, and it is really the most stable and probably one of the safest avenues to invest your money in that there's ever been since the beginning of time. So I don't say that just because I'm in it, but it's true, and that's where I put my money as well. Take some time, inform yourself, and then just do it. That would be my advice.
Yeah, I would say that's almost right on par with what we're really trying to get out to our listeners on each episode. I know we said if you're just starting off, try to really consume as much content as you can, either that be podcasts, reading books, reading articles, just staying up to date, I think is a huge focus. And then also just getting out there and actually investing, I think is another huge part, because I know some people are scared to take that leap of faith or that first step. But like I said, once you get in, you don't want to get out. And just being able to really take that leap of faith is a huge step. And also, I know you mentioned there's so many things that go into each investment or really understanding the investment. But I think once you actually start listening, reading more, it really simplifies down. And it is that, I know we've said it before, that safe, long term, very achievable wealth building investment. And just being able to simplify that and understand that, I think once you're able to recognize that, it'll help you immensely in your investment career. And then I guess moving on from there, I would say with Harvard Grace Capital, what do you see next for your company in the coming years? Anything potentially in the near future, or what's on your radar?
I would say just because we're old and boring, it's more of the same. We've got several things that we're chasing currently, and over the years, it's been funny. It can take 2-3 years just to get one you've been talking to the people about. They're just not ready to sell, and we're not ready to pay their price. But you keep talking. I guess it's like the girl you keep seeing at parties, and you just, well, maybe next time, and you just keep talking until one day there happens to be a deal. So we've got properties we've been following for a while, and then new ones come on. Sometimes the new ones go fast, and but usually they all take a little bit of simmering until they're ready to be fully cooked and served. So to us, it's more of the same, stabilized, cash flowing, distributions to the investors. Our slogan is, I don't know if you can see that, it's our notepads. Boring is beautiful, right down there. So
I
we love
love it.
boring stuff. So.
Yeah. Boring is very stable. It doesn't hurt you. I know we talk about it all the time. You can't you can't lose any money taking wins or small wins every day. So just
That's well
stacking up those
said. Yes.
small wins
Yes.
ends up being really big in the long term. So just trying to
Yeah.
stack up those small wins, it goes a long way.
Yes.
So yeah, I love
1% a
that.
day is all I ask. So
Yeah, 1% better.
Perfect. I know we're kind of coming to the end here of today's podcast and this conversation. Just wanted to take a second here, Stuart, before we hop off and wrap this conversation up, to thank you once again. I know Aaron and I, we appreciate your time for coming on the podcast today, and really, I feel like we have a lot of good content from today's episode. I think our listeners are really going to get a lot of information out of this. So thank you for that. If you guys have any other kind of closing remarks, I'll kick it back to Aaron. But other than that, thank you again, and we appreciate it.
Great. Thank you for having me.
Yeah, thank you for coming on again. And I guess the last thing would be: is there anywhere particular where listeners can find you and learn more about you?
Yeah, I invite everybody, in the easiest way to get in touch with me is go to Harvard Grace Capital. You'll find my Calendly link there, and I genuinely offer that. And podcast listeners reach out to me often, and I invite them to do that. We can talk about just about anything as long as it's real estate. But out there on the site, there's some decent resources that you can get for just sharing your email address, and I think they're helpful. And then again, my contact information is there, so everybody's welcome to reach out.
Great. Well, that's perfect. Thank you again for coming on to the episode, and hopefully our listeners got a lot of good knowledge and loved today's episode. Thank you.
You bet. Thank you.